Welcome back to Catch the Upswing, the podcast where we explore ideas that spark resilience, opportunity, and inclusive growth. A topic that many of you have asked about is the idea of investing in women, not only as founders and entrepreneurs, but as capital allocators and decision makers in the broader economy. So today I want to unpack this theme in a way that's accessible and meaningful, not just for investors, but for anyone curious about how we can build stronger, more productive, and more equitable systems. Let's start with a stark reality. Women-owned startups attract only about 2% of venture capital funding globally, and yet they deliver twice as much revenue per dollar invested. So the question becomes, why is so much potential still untapped? And what changes when we start investing differently? Let's begin with the funding gap itself. Across global venture capital markets, companies founded by women receive an extremely small slice of total capital, typically around 2% of all VC dollars. And when you look more closely, the picture becomes even starker. For women of color in the United States, venture funding consistently remains below 1% of total VC investment. 1%. And that's not because women aren't building compelling businesses. In fact, the data tells a very different story. Several analyses, including research by the Boston Consulting Group in partnership with Mass Challenge, show that women-founded startups consistently demonstrate superior capital efficiency. When you control for the amounts raised, women-led teams often generate more than twice as much revenue per dollar invested compared to male-led peers. So what we're seeing isn't a lack of performance. It's a systemic misallocation of opportunity and resources. And when capital consistently overlooks this much talent and potential, it doesn't just limit individual founders. It limits markets, innovations, and growth. One natural question is why? Why, if women-led companies perform so well, do they receive such a tiny share of capital? Research and interviews suggest a few key barriers, many of which are structural or behavioral. So first of all, capital networks tend to be homogeneous, meaning those with decision-making power often fund people who resemble themselves. And pitch dynamics can differ. So women founders are more frequently asked risk-oriented questions, while men are more frequently asked growth potential questions. You'll often hear this described in research, but it becomes much clearer when you picture what that actually looks like in a pitch room. So imagine two founders pitching very similar businesses. A male founder is asked questions like, how big can this get? What does scale look like in 5 years? Or if everything goes right, what's the upside? A woman founder pitching a comparable company is more likely to hear what happens if customer acquisition is slower than expected, how defensible is this if a larger competitor enters, and what's your plan if the market turns? Now, neither set of questions is wrong, but they lead the conversations in very different directions. One set invites a story about ambition and growth, and the other one pulls the founder into explaining risk, mitigation, and downside. And over time, those differences matter because venture capital rewards confidence in upside, not just competence in managing risk. Another dynamic that shows up again and again is pattern recognition that can unconsciously filter out founders who don't fit the industry's default mold. Venture capital, like many industries, rely heavily on mental shortcuts, especially under uncertainty. If the last successful founders and investor-backed looked a certain way, came from certain schools, spoke in a certain style, or had a certain background, the next promising founder often gets judged against that mental template. So picture this. A founder walks into a room who reminds the investor of someone they've backed before, maybe a former colleague, a previous success story, or even just a familiar archetype. There's an immediate sense of ease. Rapport forms quickly. The benefit of the doubt is extended. Now imagine a founder who doesn't fit that familiar mold. She might be building a strong business, but the investor spends more time trying to place her, more time questioning whether she's venture scale, more time wondering whether she'll be able to lead aggressively enough, raise the next round, or command the room. None of this is usually intentional, but it means some founders start the conversation ahead while others start it having to prove they belong. When you put these dynamics together, the kinds of questions founders are asked, the mental shortcuts investors rely on, it becomes easier to see why the funding gap persists even when the performance data tells a very different story. So in short, the pipeline of talent isn't the issue. The issue is who holds the capital and how they think about risk and opportunity. This is really the heart of today's conversation. If the problem isn't a lack of talent or ideas or pipeline, then one of the most powerful levers for change is who gets to make investment decisions. There's strong evidence showing that when women are part of those decisions, capital flows differently. Venture capital firms with at least one women partner are significantly more likely to invest in female founders. In fact, widely cited industry analysis show that firms with a higher share of women in leadership are about 2.3 times more likely to back female founder teams and are 4.7 times more likely to invest in female founders than firms with all male partners. This isn't just correlation, it's a structural influence on where capital actually goes. I've seen this firsthand in my work with hundreds of female investors across global markets. Many of them care deeply about leveling the playing field for women founders because they recognize the opportunity. And we're seeing a whole new generation of women-led fund managers who are very intentional about the role they play in shifting capital towards women, while also delivering strong competitive returns. There is a clear commercial case for investing in women. And there's also strong evidence that gender balance within investment teams improves performance. For example, research by the International Finance Corporation, IFC, in collaboration with Oliver Wyman, found that private equity and venture capital funds with gender-balanced leadership teams generate a 20% higher net return. So, in very simple terms, more women capital allocators leads to more capital flowing to women entrepreneurs and stronger returns overall. And importantly, this pattern doesn't just stop at venture capital or private equity. We see it across asset classes, markets, and geographies. Because capital doesn't move in the abstract. It moves through people. Now, let's flip the lens. We've talked about performance, but what's often missed is what actually changes when women receive capital at the right moment and at the right scale. When women entrepreneurs are properly funded, they don't just grow companies, they grow ecosystems. They create jobs, often in sectors that are deeply connected to everyday life. Healthcare, education, care, food systems, climate solutions. They tend to hire more inclusively, invest in workforce stability, and build businesses that are embedded in their communities. So the cost of underfunding women isn't just about missed returns. It's about fewer jobs created, fewer innovations brought to market, and slower, more fragile economic growth. When women don't get capital, we're not just holding back individual entrepreneurs, we're holding back entire value chains. That's not trivial, that's economic impact. And this is where individual investment decisions start to shape national and global outcomes. And here's where the impact case really becomes compelling. Investing in women doesn't just change balance sheets, it changes lives and communities. When women are economically empowered, household well-being improves, especially for children. Health outcomes tend to rise, education outcomes increase, and communities exhibit more resilience and adaptability. These aren't just social extras. They're critical components of thriving economies and resilient societies. By unlocking opportunity at scale, investing in women contributes to stronger labor markets, more innovation, and broader social prosperity. So what's the upshot? Investing in women isn't a niche theme or a collateral topic. It's a strategic opportunity with real economic and social value. It's about recognizing that women-led businesses perform strongly, that women allocators shift capital flows, and that investing in women catalyzes positive outcomes across families, communities, and markets. If we're serious about growth, resilient growth, we cannot afford to overlook half the human potential in our economies. Thanks for listening to Catch the Upswing. If this episode sparked a new question, offered a fresh perspective, or shifted how you think about opportunity, I'd love for you to share it with someone who's thinking about capital growth or the future we're building. And if you want to go deeper, make sure to check out my conversations with female investors and entrepreneurs on this podcast. These are women who are not just talking about change, but are actively moving money, shaping markets, and building what comes next. Until next time, turning energy into action.